When you launch a new brokerage, keeping your accounting in-house is usually the smartest move you can make. You need to preserve capital, and paying for external solutions early on often feels like an unnecessary expense. But as the agent roster expands, the sheer volume of manual entries and split calculations begins to exceed the capacity of those early, frugal systems. This decision tree illustrates the typical breaking point. Operational needs shift based on agent count. Under 20, DIY accounting is a viable, lean operation. Push past 20, and that volume creates tangible strain. Tangled data flow leads to friction that slows growth. This friction eventually impacts your bottom line, as administrative tasks begin to cloud the financial visibility you need to run the business. To understand how to manage this transition, we need to audit the 7 specific friction points where in-house accounting typically fails. This audit will help you diagnose whether your current back office is still a lean asset, or if it has become a liability that is quietly capping your potential. The friction usually starts with the software. Most brokerages try to force generic, off-the-shelf accounting tools to handle highly specific real estate finances. We can evaluate this using a quadrant chart, measuring the operational effort you put in against the actual impact on your brokerage's growth. Generic tools struggle to automate multi-tiered commission splits and team caps, requiring constant manual workarounds just to keep the records accurate. This places generic technology in the high-effort, low-impact quadrant. You are working harder just to maintain a basic level of functionality. When the software fails to automate these tasks, your admins and even your agents are pulled away from their primary roles to manually reconcile ledgers. This lost productivity lands deep in the negative impact zone. It creates an internal bottleneck that actively consumes resources rather than generating them. Every hour your team spends wrestling with inadequate software is an hour stolen from recruiting and other revenue-generating activities. Without automation, your brokerage relies entirely on human data entry for calculating complex commission pipelines. When staff are manually typing calculations for dozens of transactions every week, mathematical errors on payout day become a statistical certainty. Incorrect commission splits damage the trust of your top-producing agents, leading to avoidable disputes and frustration. These errors represent a severe negative impact. You end up spending your time managing conflict instead of closing deals. On the back end, manual processes also lead to a rushed month-end close. A rushed process increases the likelihood of delayed or compromised trust account reconciliations. In a regulated industry, these accounting mistakes quickly turn into compliance risks and legal vulnerabilities. Human error in commissions and compliance erodes the trust of your team and creates significant legal exposure for the firm. As you scale, you might try to have your existing admin team absorb the rising transaction volume without adding new systems. This shifts the month-end close from a routine task into a recurring monthly crisis for your staff. You are essentially trying to fit massive, high-volume data into a fixed manual system. Eventually, the entire system overflows. This overwhelm results in financial reports that are delayed by weeks. When reports are late, you are forced to make decisions about hiring, marketing, and expansion without a clear picture of your actual margins. This cycle also leads to severe staff burnout and high turnover in the back office, which only compounds the technical issues. Processes that supported 20 agents simply lack the physical capacity to support 100. Neglecting your accounting infrastructure places a hard ceiling on the number of agents your brokerage can successfully onboard and support. The most significant expense of in-house accounting is the opportunity cost of stunted growth. You can use this scaling audit to assess your own position. Look for these 4 symptoms: delayed reports, split errors, admin overtime, and reliance on generic tech. For a boutique broker with under 20 agents who has straightforward splits and none of these symptoms, keeping accounting in-house remains a valid way to preserve cash flow. But for a scaling broker with 20 to 100 agents, experiencing 2 or more of these symptoms is your definitive signal that the current system has reached its limit. At this point, the operational friction of in-house accounting costs you more than the investment in specialized real estate software or outsourced expertise. In order to maintain your forward momentum, you simply must transition to a new system designed for your current scale. Success depends on recognizing the moment your back office setup shifts from a cost-saving measure to a growth-capping liability. Plan your operational pivot and upgrade your accounting infrastructure now, before the limitations of the old system begin to stall your progress.